It's a great privilege for me to be back at Stanford. Like the professor said, the first time I ever came to America was actually the day I arrived at Stanford. So I associate Stanford with a lot of great things, a lot of idealism, a lot of optimism, and it's also great to see a lot of familiar faces. I think there are 3 or 4 people here from my freshman dorm, which is terrific. So for the students here, I was sitting where you were about 15 years ago, although the business school didn't look like a hotel back then. It looked a little bit less fancy. But few things I'll tell you about myself before I start. The one is I am from South Africa, but I have a slightly funny accent because I lived in California for 4 years, New York for 10 years, London for 1.5 years, and I'm originally from Joburg. So when people ask me where I'm from, I often tell them I'm from Brooklyn just to confuse them, which when they get quite confused and say, really? I say, yeah, from East Brooklyn, and that confuses them even more. But I hope everyone can understand me. Other thing I would say is I used to have a ponytail, which is also hard to imagine. And the third fact about me is I started out at Stanford as a pre-med, which, I started the economics track and the pre-med track at the same time, but ultimately I decided to go into the business world. But just to get a sense for the audience, can I just take a quick poll? Who are undergrads in the audience? And business school students? Very nice. And members of the community, faculty? Oh, great. Okay, so we have an excellent and diverse audience, and certainly I'm looking forward to a good dialogue because I think people are very split on a lot of these issues. So a couple things I'll say at the start. Professor Schatz mentioned, obviously, I wrote this op-ed about Goldman Sachs, but everything I say today, I very much believe is true to the industry more broadly. I don't think Goldman definitely is a smart firm and an excellent firm in what it does, but I don't think its practices are very different in a lot of ways to the industry more broadly. So, when I wrote the book and I wrote the op-ed, I was using my career there as a prism to what I think has become conflicted in the industry more generally. The second thing I would say before I start is I think a lot of people would want to classify my views or this talk as in the Occupy Wall Street camp or in a different type of camp. What I would say is I'm very much a capitalist. I just have the view that free markets imply that the playing field is fair and there aren't lots of conflicts of interest. And a big thesis of my book, and what I was trying to get across in the op-ed, is the fact that capitalism, at least in the financial industry as it's going on now, I no longer think is on an even playing field. I think advantages are stacked in favor of banks and against their investors and clients in many respects. And I think there's maximum incentive for the system not to change. And I'll get into this a little bit more later on. But let me tell you the 3 things I'm going to discuss today. The first is, has anything really changed in the industry? Certainly, when I wrote the op-ed, a lot of people said, well, things have always been this way, or Wall Street has always operated in a certain sense. So I'm going to tell you how, at least since I was sitting where you were 15 years ago, in my opinion, things have changed. The second thing I'm going to tell you is, with all these changes, how do banks exploit conflicts of interest to make money in a way that I view as unfair at best and potentially very systemically dangerous to society at worst. And the third point will be a little bit about what needs to change in order to fix this and why hasn't enough changed. And just on that point, I would ask, how many people in this room have heard of the Dodd-Frank Act? How many people think the Dodd-Frank Act has been implemented? So 4.5 years after the crisis and 2.5 years since Dodd-Frank was passed, less than 1/3 of Dodd-Frank has been implemented, and more than 3/4 of the deadlines have been missed, and $400 million has been spent lobbying against it. So I want to touch a little bit at the end about this perception that conditions have changed, and really try to show you guys why they haven't changed as much as I think Obama or Romney or any number of politicians would want people to think. So starting with the point of what has changed. So I think absolutely there have always been practices on Wall Street that are not great and that are dubious. But what I would say, the simplest way to mark what has changed is look how banks make their money. So when I joined the firm in 2000, or let's just say when I joined Wall Street, at least half the money was being made in the original things that made finance get called finance. Wall Street financed things. They helped companies raise money. They advised companies on merging. They acted as an advisor in all sorts of capacities. So when I joined, about 60% of Goldman Sachs' revenue was in the banking side of the business, where certainly there are always going to be conflicts, but there are less conflicts than in the trading side of the business. So fast forward to 2007, close to 80% of the money is being made in the trading business, which is a very marked change, which I don't think people can debate as being non-factual. But what that kind of revenue change does is it leads to behavioral changes and cultural changes. So what occurred that allowed this revenue shift to change? Three main things occurred right around the time when I was joining Wall Street. The first thing, in 1999, there was a thing called the Glass-Steagall Act, which separated commercial banks from investment banks. It was repealed. In 2000, there was a thing called the Commodity Futures Modernization Act, which essentially took complex securities called derivatives and deregulated them. So allowed the trading of derivatives to move off exchanges, basically into the dark. And the third thing that happened was a thing called the net capital rule was overturned. And what that did is it allowed banks to increase their leverage from, now leverage, for those who don't know, is basically if you have $1, you can effectively lever yourself up by taking bets 10 or 20 or 30 times the amount with the $1 you have by borrowing extra money. So from the early 2000s to the mid 2000s, banks took their leverage from 5, 6, 7 to 1 up to 35 to 1. So with these three things, which were all regulatory in nature and which were all ultimately lobbied for by the banking industry, it became very clear that, as the professor said, the old model of long-term greedy, which long-term greedy was a motto that Goldman Sachs had for many years, which essentially said, if we do right by clients over the long term, and maybe we turn away business in the short term that's going to affect our reputation, ultimately they'll keep coming back to us and we'll have a collaborative relationship where the client is a partner and they keep paying us and they keep doing business with us because they trust us. This shifted to a model that I would call short-term greedy, which ultimately makes more profits for individuals and for the firm in the very short term, but from a long-run standpoint, doesn't serve your business well and doesn't serve the society well, because potentially you're doing business that's toxic to your clients and ultimately endangers the system, as we saw in 2008, where Lehman, Merrill Lynch, AIG had taken such huge risk that it ultimately brought the whole system down, and the government had to come in and bail the system out. So when we talk about all these regulations occurring, what basically happens is it becomes clear that it's more advantageous for the bank to start betting with their own money, because if you can take levered bets of 30 to 1, you may actually start seeing your client more as an information provider to help you bet more smartly, as opposed to seeing your client as a partner that you help make returns and earn money. And essentially, in the early to mid part of my career, I saw this cultural shift occur where the firm started seeing what the biggest mutual funds and pension funds in the world were doing and started implementing its own bets, using this information in a way that was not front-running, technically, but allowed banks to use this big picture, kind of sitting in the middle position to bet. And you can look at the evidence. Goldman Sachs' trading revenues, for example, in 2002 were $5 billion. By 2007, it was $38 billion. And businesses don't multiply by 5 or 6 times in 5 or 6 years unless there is some meaningful shift in your mindset. So ultimately, that leads to what I'd call a behavioral or cultural shift. And this doesn't happen overnight, but if people are being incentivized to use their client information or to bet with the firm's own money, and no one is telling them that there's anything wrong with that, it ultimately filters up and down an organization. And this cultural shift occurred everywhere on Wall Street during that period. Looking, just a few examples to show this mindset shift, just in the last year or so, I mean, you can count down what I'd call scandals that show this type of swing for the fences behavior. You had MF Global, which was a futures brokerage in Chicago, where the head of the firm started taking proprietary bets on the sovereign crisis in Europe, and ultimately the firm went bankrupt. There was a scandalous situation where they were potentially using customer money to fund these bad bets, and no one has been prosecuted for that. Secondly, in the last few months, we've all heard about the LIBOR rigging scandal. LIBOR is an interest rate that affects hundreds of trillions of dollars of assets around the world, and this is I would say an example of this incentive where traders were collaborating with each other to set an interest rate because they knew they'd make more money for the firm. You look at the Facebook IPO, we can argue endlessly, was it Facebook's fault? Was it Morgan Stanley's fault? Was it the investors' fault? But certainly a manifestation of this, let's swing for the fences, try to get as much out of this deal as possible. So let me go into point 2, which is a little bit trying to explain how banks make this money using a little bit of an analogy, which I use in my book. If you compare Wall Street today, which 75% of revenues come from trading, to a real casino. So not everyone likes gambling, but whether we like gambling or don't like gambling, when you walk into a casino, you can have a lot of faith that the rules are not going to change during the game, and that there are cameras all over the floor, and that there is a regulatory body that, for the most part, is keeping an eye on things. The other thing I would say is the casino or the house is not allowed to take bets based on what everyone in the casino is doing. The casino is what I'd call an objective counterparty. So let's just run through this analogy a little bit. If you think about an investment bank, they are dealing everyone cards. And let's say at the table is sitting a pension fund, a hedge fund, a mutual fund, hundreds of billions of dollars of investors are sitting at this table. That bank or the dealer can see what all those people are doing and can then go out and use that information to place their own bets. Now, you would expect someone not to lose very often if you can see everyone's cards. And this is very much borne out in an example we see every quarter where banks have to release their results on their trading books for the whole quarter. There are many quarters where a bank will literally make a profit 100% of the time. So that's like batting 1,000, where if you go to the plate, you would not expect someone to hit every time. So you got to think to yourself, I'm sure most people in this room invest in the market. If you make money 50.1% of the time, you're probably outperforming many, many people in the market. It's very hard to understand how a trading book can make money 100% of the time unless you have some kind of asymmetric information advantage. And that is where I would come back to the analogy of you're essentially seeing what everyone else is doing, so you can bet a lot smarter with your own money. Second part of the analogy, when I mentioned the cameras. What happened with the deregulation of derivatives is the gambling can be taken to a back room where there are no cameras and no one is tracking who is losing a lot of money and who is making a lot of money. And this is an example of Lehman Brothers and Bear Stearns and Merrill Lynch, who no one knew how much risk they had on their books. And it turned out that they had all sorts of risks that no one in the market knew or understood. And this is the big danger of business being done in an opaque fashion, in the dark, in a very complex nature. So I would argue, ultimately, you need to bring the gambling out of the dark room and bring it back into the light, or an exchange where everyone can see what's going on. To continue a little bit with the analogy, and this is what I think is the most dangerous part of the way business is done on Wall Street today, it's the dealer. Now, when you're playing blackjack, I think everyone knows the rules. You know, you can't, if you get more than 21, you bust. You know, there's certain statistical probabilities you should and shouldn't be betting on. When you go into a casino, does anyone in the audience expect the dealer to give them bad information? For example, a big boy attitude where the dealer is actually telling you when you're on 19 that you should be taking another card. I think no one would expect, you know, at least when I have been to casinos, the dealer is actually kind of on your side and somewhat friendly and will tell you, you know, because you often do see people who have never gambled before who will take another card at 19 and ruin everyone else's hands. But the dealer would likely tell you this is a bad idea, you shouldn't be doing it. So I think you have this, what I would call an implicit sense of trust, where you don't expect the dealer to misguide you. What sometimes happens on Wall Street is a client or an investor will get told to do something that if they understood the rules of the road very well, they would know is not in their interest to do, yet a Wall Street firm will tell them, you should do this because that firm might make 10 or 15 or $20 million off it. And they're not technically doing anything illegal because that person walked into the casino. They are responsible for their own actions. And I think this is where a big misunderstanding comes in. And you know, I'm sure many of you remember in 2010, there was a big SEC lawsuit against Goldman Sachs, and there was a big hearing in front of Carl Levin where a lot of swear words were used on TV. The one particular word beginning with an S-H-I-T-T-Y was used, I think, 20 times because of how bankers spoke about these deals. You know, the big argument for why it was okay to sell someone something without full disclosure or without fully telling them your intentions was this idea that they're a big boy, and everyone's a big boy. If they've come to play, they deserve what's coming to them, even if there is a sense of deception or a sense of misleading them. Now, I think a lot about the word fiduciary duty, and you know, this is a word that I think gets thrown around a lot, but the essential meaning of it is when someone is coming to you for advice, if you are bound by a fiduciary obligation, you owe that client or that person the duty of telling them what is in their interest and what is not in their interest. And I think over the time I was on Wall Street, it has morphed into the sense that a fiduciary duty is not owed to anyone. The big problem with that is, I would argue, many, many clients with hundreds of billions of dollars of assets don't understand that. And you know, an example, I'll give you two examples that ultimately led to me writing the op-ed, and you know, I'd like all of you to think about just as an ethical dilemma, especially since we live in a time today where the idea of ethics versus legal are very different things. If something is technically legal and is not going to get you sent to jail, a lot of people will do those things. So the example I would give you to think about is, you know, we recently had a terrible storm, Hurricane Sandy. Everyone gives donations to, say, the Red Cross Society or any other number of charities. I think what the general public doesn't always know is Red Cross, every university endowment, Stanford, Harvard, teachers' pension funds, police pension funds, firemen's pension funds, governments, are the biggest fish in the market. They have hundreds of billions of dollars of assets, and they invest them with Wall Street. So what I would ask is, just as a hypothetical example, if the Red Cross Society came to you and asked to trade a very complicated derivative product that was going to pay the firm $20 million, yet you knew was not in their interest, but was not necessarily going to get you sent to jail because the government classifies them as sophisticated, would you do that business? And more, I saw the attitude and the behavior move to a point where, yes, we will do that business because they're a big boy. Now, I would argue it's reached a point where, because of the asymmetric information advantage I've told you about, not everyone's on an even playing field, so more needs to be done to prevent that kind of behavior. The second example I would give you, which is a very powerful one in helping me make my decision to leave, was the European sovereign crisis, which is still boiling. But we may remember last summer, or the summer of 2011, it looked like Portugal, Spain, Italy were teetering on bankruptcy. And I would go to trading meetings every morning, and our traders would have a very negative view on the European banks. Yet we were being asked to go to some of the biggest investors in the world and try to convince them why the European banks were such an attractive investment, purely because we didn't like the investment and wanted to sell the banks, but we needed someone on the other side of the trade to buy the banks. Now, if we were just talking about some arcane investment that didn't affect anyone, this might not be so relevant, but I would go to my desk and I would see the biggest banks in France and all over Europe moving up and down 5 to 10% a day. Not purely, but largely driven by this idea that every 2 days, in order to drum up business, clients at all banks across Wall Street were being convinced, today is the day to sell, tomorrow you should buy, now is the time to panic. And the truth is, our traders and traders across Wall Street didn't really believe that conditions were changing on the ground every day. And to me, this started having real world impact. There are millions of citizens across Europe who are affected by the fact that their governments can't get their act together, and banks are trying to drum up business in order to make their profits at the end of the quarter. And this ultimately became something that I thought crossed the line of letter of the law versus spirit of the law, and ethical versus legal. And I think it got to a point where I felt this wasn't the type of business that I wanted to do anymore. The final point I'll talk about before I take some questions and answers will be what needs to change in order to fix the system, in my opinion. The one thing I would say, which I don't think a lot of people know necessarily, is that the 5 biggest banks in America are now bigger than they were before the financial crisis. Whatever people claim or don't claim, banks still have an implicit, and I would almost argue explicit, guarantee that whatever they do, the government will support them. Now, just to explain this perverse incentive a little bit, there was an example last summer where a JP Morgan trader who was nicknamed, I think, the giant whale or the London whale, basically took a massive bet, lost $6 billion for the firm, got a wrist slap, lost his job. The person who ran that group, I think over the course of her career, maybe made more than $50 million and left the job. Now, if that loss had been $200 billion instead of $6 billion, the thing that happened to the person who took that trade would be exactly the same. They would get a wrist slap, they would leave their bank, and all of society would have to bail out that bank because of this existing implicit and explicit guarantee that we saw. Anyone who talks about cutthroat free market capitalism, we saw in 2008 when faced with this idea of, are you really going to let the banks fail? The truth is, the government wasn't willing to take that risk and wasn't willing to see what happened. And everyone on Wall Street knows that. And there's now this maximum incentive to swing for the fences, do whatever you can to maximize profits, because if the trade goes bad, you're just going to lose your job. But if the trade goes bad for society, everyone has to bail banks out. And I think what this amounts to today is what I'd call a privatization of the profits and a socialization of the downside risks. And that is absolutely still in force today. Anyone who claims that is not in force is not, in my mind, telling the truth. Now, why is not enough done to fix this? I would, at the very end of my book, I point the finger back at politicians. And the truth is, I think the thing we should all be most outraged about is the fact that, look at the Senate Banking Committee. Who are the firms that are giving them the greatest campaign contributions? It's the Goldman Sachs, JP Morgan, Morgan Stanleys of the world. Look at the regulators. Look at the hundreds of millions of dollars that have been lobbied in order to kill regulation. And this was very counterintuitive to me, but the way to kill legislation in today's day and age is not to get rid of it or to get it struck from the act. It's to fatten it up. And this wasn't obvious to me at first, but there's a thing called the Volcker Rule, which is designed to completely eliminate proprietary trading, which is banks betting with their own money. It started out as a 2-page document written by Senators Merkley and Levin as an amendment to Dodd-Frank. 2 years later, it's something like 700 pages because banks realized if they can get their law firms to insert hundreds of loopholes and amendments, you ultimately reach a point where the law is so complicated that no one can actually follow it. And essentially, you've achieved this victory where nothing has changed at the end of the day. So I think we need to say to politicians, number one, why don't you have the political will or the guts to actually fix a problem that affects everyone? Banks can still be profitable. They can still do the things that serve society or serve, I would say, economic prosperity, which is raising money, helping companies merge. But when 80% of banks' profits are coming from trading, I don't think banks or politicians are being honest with the public with how their money is being made. And you look at commercials on TV for Citigroup or Goldman Sachs or JP Morgan, you would think they're in the business of helping New Orleans rebuild or about giving money to charities. And certainly there is a significant amount of philanthropy on Wall Street. But I would say to you, the amount of money that's made by helping New Orleans rebuild or investing in urban communities is less than 10%. I think there needs to be a greater sense of honesty where people actually are upfront and say, look, 80% of the money is being made in a business that the public doesn't understand. Frankly, politicians don't fully understand. And I would say to you, regulators are not, I would say, resourced enough or nimble enough to understand things because they're so complex. So what I'm advocating for is a return to the old long-term model where you do business, you make money, your clients make returns, banks can still be profitable, and people who do things that risk, I would say, the systemic safety of the economy are held accountable. And the way to do that, and I'm not a huge fan of regulations, but I think the three big things you need to do, the one is derivatives. You need to bring them back into the light. You need to bring them onto exchanges. Proprietary trading through the Volcker Rule, you need to outlaw it. And the law does not have to be 700 pages. The law can be 1 page. Now, a lot of times banks will hide behind the idea of market making or hedging, which is a more complicated discussion, but I would tell you is a way to hide behind something that still lets you continue to do proprietary trading. And then the third one, which I'm interested to hear what people in the audience think, is about, are banks too big to fail still? And are they too big and too complex to manage? I would say they definitely are. And I would say there's a critical mass building where you don't want to be destructive to banks, but when they're still so systemically dangerous, is there merit to making them smaller, where you split off the trading business from the retail side of the business? And I would argue, yes, there is merit to that. So with those three things, I'll leave it there, and thanks for listening, and I'll open it up for questions.